the checklist items that they need. And then the capital raising, we're going to focus on that today. And how do we structure these deals so that we're complying with the SEC regulations? Because when you're raising capital privately from individuals, it is governed by certain rules and regulations that you need to know. We also have our own title company, and so we handle the title and the closing, and we do it all, really, from soup to nuts. I'm also an investor, right? I've got about 600 doors myself, a multifamily that I invest in, passively, and also on the GP side in some instances. So, very well versed in this game, and happy to talk to you guys today. So, whenever I give these kinds of presentations, I want to ask a question: What is the number one rule of real estate investing?
Don't lose money.
That?
Don't lose money.
Don't lose money. People always say that. But I would say that's 1B. What's 1A? That's right. Use other people's money, right? Use other people's money. Some of the services we provide. Of course, I am an attorney, so this is a disclaimer. We're not, gotta have my disclaimers in here. Use other people's money, and that could be the bank, right? That could be the seller in certain. I think Dean will talk about that later. Some creative finance ways. Friends and family, institutional investors, and even strangers in some certain circumstances. And we'll talk about how to do that, right? Like, how are you going to get a stranger to invest with you, right? Well, you start in that road now by getting a track record, getting into communities like this, and building that investor database. So you're both right. Rule 1B is definitely don't lose that money that you get from other people. But rule A1 is to use other people's money. What do you need this money for, right? You're raising capital to purchase. You just learned how to underwrite a deal. What do you need all this money for, right? You need your acquisition fee, which we talked about, your down payment, your closing costs, your operating capital and reserves, your capital improvements, your financing costs, right? You're going to borrow money from a lender, but the lender's going to charge you for it, right? You have to come up with some cash to pay for those things. So we do that through what's called a real estate syndication. Who's heard of the word syndication before? Right? So what is a syndication? A syndication is essentially a partnership, right? It's a partnership between an active member of the company and passive members of the company, right? So the idea is you find investors that are high net worth individuals, high W-2 earners, maybe business owners. They're good at running, a funeral home, but they're great they're terrible at investing, right? They have a lot of disposable income. And they don't want to manage real estate. They don't want to manage with tenants, toilets, and tantrums, right? The 3 T's of multifamily, right? They don't want to do that. They'd rather give their money to you and let you do it, right? Because all you guys are future sponsors in here. And so we're going to do that through what's called real estate syndication. And this actually came from the United States Supreme Court, a definition from 1946 where the Supreme Court defined what an investment contract is, right? And so whenever someone is giving you money, and they're expecting a rate of return, right? Different than a promissory note, different than interest, but they're talking about, I'm going to get a rate of return based solely on your efforts as the promoter, right? Not just because you owe me the money like you would under a promissory note, but I'm saying I'm going to give you money, and you're going to pay me back interest, plus I'm going to get a share of the profits, right? And I don't have any management control or rights in the deal at all. If that's the arrangement, that is the definition of a syndication. That is, you're dealing with passive investors. You need to be aware of the SEC regulations and how to actually structure these deals. Okay? Now, the syndicator is typically what we call the sponsor. The sponsor is the one that gets a share of the profit at the end. The promote gets the acquisition fees, and a larger share of the profit goes to the LPs as your investors. So there are a lot of times, and I always have this slide because, how do you get into deals like this if you have no track record, right? That's the hardest thing that people ask, and it's just hard, right? You can't really get involved with other investors. Who's going to give you money? The first thing you want to do is you want to partner with people, right? Partner with people within this community. Partner with more experienced investors, more experienced GPs. Just get on the GP team, right? When you gotta offer one of 3 things: either it's value, money, or time. And if you can offer one of those 3 things, you can get on one of these deal teams, get your experience as a GP, start your track record that way. Now we'll talk briefly about the difference between a joint venture and a syndication. Right? A syndication, there's passive investors, right? You're taking money, you're buying the property, you're fixing the property, you're selling the property, and you're not, the investor has no say at all. joint venture, say there's 5 of you in here that get together, you're all gonna put in $100,000 a piece, and you're gonna go buy a piece of property, right? The way that operating agreement is drafted, you're all members, you designate one managing member, that's gonna like run the day-to-day. But then big decisions like selling the property, executing large contracts, maybe meeting other members, those are big decisions that require everyone's consent, everyone's vote, right? If that's the way the company is structured, that is a joint venture, right? That is not subject to securities regulations. Now, it can get a little dicey when, okay, I get this call all the time, Todd, we're going to do a joint venture, we got 15 joint venture partners. Come on, guys, that's not a joint venture, right? You can't really have a company that, all of you are going to be making decisions, like, come on. So a rule of thumb, 5, 6, 7 is okay, but you gotta document corporate meetings, you gotta document that you're making these decisions together, things like that, to really prove that it is a joint venture, not a syndication. So how deals are structured, guys, this is a simple version. Everyone starts out this way, right? You've got the investment LLC, the investment LLC right here. This is the company we formed to purchase the property. I hate having my back to you guys, sorry about that. The investors are going to purchase membership interests in this company, right? This relationship is going to be governed by what's called a subscription agreement. That agreement acts as the purchase contract between the investors and the entity, right? And then the manager, this is you, right? This is where you're going to manage the property. So the management is going to flow up this way. Right, and that's what lenders look for. Lenders look for who's in control of this company, right? And multifamily, like Dee was talking about earlier, there are specific lenders that only do multifamily, right? And they know this structure. Now, if you go to your local community bank and you want to get a loan for a multifamily property and you want to structure it this way, you may have to do some explaining to them because they don't see this every day. But typical, Wall Street multifamily lenders, they know this structure, right? These guys, your LPs, they have no say at all. So this operating agreement says they're completely passive, no voting rights, no management control, no nothing. They're just given money, and this sponsor is going to make money for them through the business plan that we just learned about, the execution strategy, and then when we sell, you're going to get the larger share of the profits going back to the investors. So this is the sponsors, right? The sponsors are members of the manager LLC. The manager LLC receives cash distributions and fees. Okay. Cool thing about syndications as well is that you, as the sponsor member, you're going to put in probably about 10% of the required equity, right? And if you do, you don't have to. A lot of lenders require you to, and if you do, you're going to double dip. Because any money that's put in from a Class B member or a sponsor member is treated as Class A equity. So if you put in cash in your own deal, you're going to get LP returns. And then when you sell the property, you're going to get that large GP split as well, right? So everyone starts out this way. Everyone wants to end up this way, right? So this was actually a Texas deal that I did. Very complicated, but just giving you an idea of how some of these deals are structured. This was a 3-property portfolio. I had different groups with different investor bases here. So this was a separate group, this was a separate group, this was a separate group. So these 3 guys came together to take down 1,000 units in Texas. And we had literal Wall Street institutional private equity here. And this is just it was a big, very complicated deal, right? So you start out here, very simple deal. We get to this type of deal when you get that track record, that experience, and start taking down. Because I'm telling you, the first deal is the hardest deal to get. But once you get that first deal, it snowballs after that, right? You start becoming a closer to the brokers you know, you start getting those pocket listings, you start getting those off-market deals. That is when it truly snowballs. So who are the members of this company? So we're talking about this company right here, right? We have Class A and Class B members. We make the limited partners Class A. We just make them feel like they're more important than us, right? So they're Class A. And I say this a lot on my social media feed. I say, what is more important? Is it the LPs that put in the cash, or is it the sponsor that implements the business plan? Right? I'll do a poll sometimes on my social media, and it's often a mixed bag, right? Those who invest a lot in deals will say the LP is the most important because you can't get a deal without the cash. Those who run deals, those who are sponsors, say, well, you're not going to make any money unless I implement the business plan, right? But the members of the actual company are Class A, Class B. Class A members, they're all limited partners. They subscribe to membership interests and no voting right or management control. They usually own a larger share of the equity, and they're offered a preferred return. I think we were looking at the underwriting a little bit earlier. What is that? That just means these LPs get paid before you get paid, right? So in the flow of cash flow, you have your gross receipts, you've got your expenses, you've got your NOI, then you pay your debt. After that, you have pure cash flow. You use that money then to pay your preferred return to your investors. Once that preferred return is hit, then the GP can get in instant cash flow, right? And so that just really helps investors, feel good about the deal. Now there's a million ways to structure these deals, and this is what I do all day long. You can have large preferred returns, small preferred returns. You can have what's called waterfalls, where the preferred return, the split. We talked about 70-30 earlier, right? 70% going to the LPs, 30% going to the GPs. Well, what if you distribute enough cash that the investor is now at a 12% IRR? You heard that term earlier, right? Well, that 70-30 may go to 60-40, right? So your incentives are aligned, right? The more cash you can produce from this property, the more cash you're going to get as a GP. So a lot of times we do IRR waterfall hurdles to structure it that way, to really incentivize the GP. It can get a little complicated. Sometimes it's harder for investors to understand. So we may just do a simple, 80% pref and a 70-30 split. Class B members, these are the management structure. Those are the individual sponsors. They own a percentage of the company, held by the manager company. They actually have voting rights and control over the company. So how does the cash flow? We just talked about pure cash flow, right? After the NOI, after the mortgage is paid, typically you offer a preferred return to your investors, and it's paid quarterly. So whenever I talk to investors, I say, look, if you invest $100,000, or any of my clients, right, and the preferred return is $8,000, or it's 8% rather, that investor is going to get $8,000 per year. Usually $2,000 a quarter is going to show up in your account because we're hitting our targets. And that makes the investors feel good, right? So it's not like they're waiting 3 to 5 years to get anything, right? They'll probably forget about the investment. All of a sudden they get $2,000 in their account. They're like, oh, okay, now I remember why I did this, right? But like what Dee said earlier, that's a small benefit. The bigger benefit is the tax write-offs, the depreciation, the cost segregation. And then when the property is either refinanced or sold, that's when the bigger check comes and the 70-30 split is usually implemented. So I wanted to mention this. This is a little chart here, and the reason why I brought this up, this is kind of the same kind of deal where we have the investment LLC here, the LPs are investing in. This particular deal is a 65-35 split, so you can see that here. But this particular deal, they did not have, we can talk about this later in underwriting, but to go after these larger deals, you need to meet certain net worth and liquidity requirements for the lender. And it's usually a net worth of at least the loan amount. So if you're going to get a $5 million loan, you as the GP team need to have at least $5 million of net worth. And liquidity, you need to have at least 10% of the loan amount in liquid cash, right? And so you got to produce your bank statements, you got to produce your brokerage account statements, you got to show the lender that you have that. Now, it's usually the GP team as a whole, so it would be all these guys. But in this deal, this was the main sponsor. He had one partner. Here, and he did not meet the net worth and liquidity covenants for the loan. So what did he do? He went out and found a high net worth individual and said, look, I'll give you 9% of the GP if you just come on board, lend your balance sheet to the deal so the lender sees that you're part of the deal, and I'll give you 9%. So he did, right? So that, again, that's the concept of strategic partnerships in this game, right? It's very much a strategic partnership play. So we talked, and I'm going a little fast, because usually I do this in an hour, and I have 30 minutes, so I'm going through it. So, raise questions if you have them, and I'll answer them as best I can. We talked a little bit ago about this Supreme Court case. The question you need to ask yourself is it a security or not? If you're dabbling in this game, you're going to grab money from investors. You're going to structure it as a joint venture. You're going to structure it as a securities offering. You need to make that decision. There's an investment of money. There's a common enterprise. This is the big one, expectation from the investor of a share of the profits, solely from the efforts of the promoter. That's you, the sponsor. If it's solely based on your efforts, hey, I'm going to implement the business plan, I'm hiring the property manager, we're increasing the value, we're turning these units, we're now charging $1,500 a month rather than $1,000 a month. Those are your efforts, right? If that is the case, then you must either register the offering with the SEC, or it falls under some exemption. We'll go over those exemptions right now. This is a little flow chart that we've created. You can ask yourself this, right? Is it a security or is it not? If it's member managed, that typically leads itself to the joint venture world, right? Because you have actual management of the members of the company, right? So any JV that we create, we make it a joint venture. We make all members active and all investors take an active role. If it's manager managed, as we talked about earlier, typically you're in the SEC realm, right? You got to be thinking, okay, this is probably going to be an investment offering. And then we have two types of offerings, and I say that I have this slide because this is what we call a private offering, not a public offering, right? This isn't an IPO, right? You guys heard the term IPO, initial public offering. Tesla goes public, or Uber goes public. That's called a public offering. Those offerings are fully vetted by the SEC. There's investment bankers involved. It goes through the whole process of approval, right? That's not what we're talking about. That's not us. That's not syndication. We're in the private offering. So there's a regulation of the Securities Act 1933 called Regulation D, and it says these types of offerings are exempt from SEC registration. So you don't have to go through the SEC first. But what you do have to do is to notify the SEC that you've completed this capital raise, right? That you've completed this offering. Now there's two types of avenues, two types of options when raising capital. There's 506B and then there's 506C. Neither offering have any limits on the money that's raised, okay? But the big difference is, the first question you gotta ask yourself is, do we need to advertise this offering? Do I need to go on social media? Do I need to have events like this? Or sometimes when you're raising capital, sometimes you have events like this and you'll pitch the deal, right? But if all the people in the crowd are strangers, that's advertising, right? So if you're gonna advertise, you have to use a 506C, right? And what the rub is that the SEC came up with from the Jobs Act of 2012 was that, okay, we'll let you advertise these offerings, but you cannot have any unaccredited investors. So 506C equals only accredited investors. 506B, we call that the friends and family exemption, right? So in that exemption, you're not allowed to advertise, and you can only have 35 unaccredited investors. And I'll tell you what an accredited investor is in just a minute. So it's a B or C. Most new sponsors, they start out with a B, right? Because they may not know a lot of accredited investors, right? But if you've got a marketing machine and you're able to market and you want to go for a C, you can do that, right? A lot of times what we'll do too is we'll convert from a B to a C. So people start out with a B and they realize, crap, we didn't hit our capital raise targets. We need to convert it to a C. Now we can do that. It's a bit of a process because it's a separate offering. You have to delineate a moment in time when the B offering is over and you have a new C offering. But in the B, just remember, only 35 unaccredited investors, no advertising, and you need a pre-existing substantive relationship. And I'll tell you what that is in a minute. C, you are allowed to advertise, right? But no unaccredited investors. Big difference. And you don't need a pre-existing substantive. So when I'm talking about raising capital from strangers, you do that through a 506C offering, right? How we talk about this main difference here, same thing, 35 sophisticated but unaccredited. And we say sophisticated because, if your neighbor next door is a school teacher and her uncle passed away and left her $10 million, and you just happen to know that, right? You go knock on her door, hey, you want to put some of that with me? Right? They're not really, you have to have some level of sophistication when it comes to finance and real estate to be even a non-accredited investor. I've never seen the SEC challenge that. And again, that doesn't mean you can't educate this neighbor. Hey, why don't you come to some of these events? Let me show you how to use this capital. They get educated, that's fine. But you just need to have usually some level of sophistication when it comes to that. So who are accredited investors? So you are accredited if you're an individual, you've got a net worth of $1 million or more, excluding your primary residence, okay? Or your income is $200,000 or greater if you're by yourself, or $300,000 if you are married and you file joint taxes. If you're an entity, you have a net worth of at least $5 million as a standalone entity, or the owners of the entity are accredited themselves. Everyone else, not accredited. So when we go back to our capital raising, we see here it says accreditation may self-certify. What that means is when we prepare our documents and we're doing a 506B, we give them an investor questionnaire. And we let this just checkbox, right? Yes, I'm accredited, or no. Great, your duty is discharged. If you're a C, you have to go one step further and actually ask them to prove it, right? Give me a letter from your lawyer or your CPA, show me your tax returns, show me your brokerage account statement. Yes, sir?
Is a fund a 506B or is that something separate?
So a fund can be either one as well. It can be either one. And in a fund, and I don't talk about funds here, but there's also 367 or 3C6 and 3C5. There's different other regulations, because in a fund you have to deal with what's called the Investment Advisors Act and the Investment Company Act. So those are two other regulations they have to be concerned about. But usually a fund is a C, typically. Yes, sir.
Can you start out as a 506B and then you don't raise the capital you need and then try?
Yeah, you can convert to a C. You can convert. Now, you just have to, there's usually a cooling off period. The B offering is closed. We wait, 2 weeks, 3 weeks, and then we start to C, right? Yes?
So what are the penalties if you don't?
You don't do this? Good question. Well, the SEC could, start an enforcement action, right? If you're not complying with the SEC regulations, they could investigate the offering, start an enforcement action, and levy fines.
Is that something you do often?
I mean, it's a matter of your risk tolerance, right, as a sponsor. But yeah, I mean, there's a whole division of the SEC that's the enforcement division. Their only job is to look for violations of this. Now, they're more worried about the Bernie Madoff of the world than these, guys doing capital raising for multifamily. But there are a lot of cases of, the biggest thing here, guys, is just be honest with your investors, right? Don't overpromise and underdeliver. Don't misrepresent anything. Be upfront. Over-communicate about the deal, right? That's the biggest thing, because any of these LPs, they just can call the SEC and say, I think the guy I invested with is stealing my money, right? That's all it takes is one phone call, right? Everything's great. No one's going to call anybody as long as you're doing well. But as soon as you start, if something goes wrong, you may get one of those calls. Yes.
So these rules apply not just for multifamily, but all securities.
Correct. Correct. Yeah. All real estate investments, right? So I mean, I've done these types of deals for stock investments, like investments in funds that go out and invest in the stock market.
If the investors are in the U.S., but the assets are not, do they still apply?
It applies to U.S. investors, right? So
So if the U.S. investors, but the assets are foreign, it still applies.
it still applies, right? Yeah. If it's a U.S. company raising capital, even to invest in a foreign asset, it still applies. Now, I've done deals where I've had foreign investors who the offering is completely foreign. There's all foreign individuals, from Singapore and the Far East, and they're investing in the U.S. That the SEC has no jurisdiction over that. So all of the investors are foreign. Right. Yeah. So what is a pre-existing substantive relationship? This is important, because if you're doing a 506B, we call that friends and family exemption. You need to have some pre-existing relationship. Now, the SEC doesn't give us the playbook, right? They don't tell us what that means, but we can gather, there needs to be some prior relationship, between you guys, right? If it's a brand new person you've never met before, they're not going to be in your contacts. But as your job as an emerging sponsor is to grow your network, right? You've heard that, the more hands you shake, the more money you make. So true, right? And there's another cliche, your network is your net worth, right? So true, right? But everyone that you meet in this room, you get everyone's business card, you have a conversation with them, they're in your CRM, that's a pre-existing substantive contact for you, right? You get your first deal, you raise capital, you send it out to the group, and send it out to the community, you're good. But there must be sufficient time between establishing the relationship and the offer, so it's not considered advertising. You have to have that pre-existing relationship. Now, what do we do when you're buying a deal and you're the deal guy, but you can't raise capital? And your friend has a lot of contacts and he can raise capital. But you don't know those people, right? So you don't have a pre-existing substantive relationship with your friend's contacts who can raise $1 million. How do you handle that? Well, you go back and you bring them in. Right? Again, strategic partnership. So bring in that person who you think has the capital relationships. They have to be a part of the deal. You can't pay them consulting fees. You can't pay them capital raising fees. All of that violates FINRA and those broker-dealer regulations, right? Only licensed broker-dealers can get paid a fee for raising capital. So if you have that license, great, you can charge a fee. Most people don't. But what you can do is you can bring him into the deal, give him kind of the GP, and then all of a sudden the GP team as a whole has that pre-existing relationship. 3 minutes? Okay.
What licensing for those?
It's like Series 63 or one of the series, I'm not sure. 67, yeah, something like that. Okay, I've got 3 minutes. Okay. So, pre-existing substantive relationship. What's a sophisticated? We talked about this. You know, defined by SEC, someone who's got sufficient knowledge and expertise, right? Typically not the neighbor down the street. But again, you can help them become sophisticated. One of the main documents we draft is called the PPM, Private Placement Memorandum. I'm going to trademark the term PPMCYA, right? Because that's what it does, right? It is a document that covers your ass in case something goes wrong. This is your giant disclosure document, right? Your voting rights, liquidity, dispute resolution, description of business, offers of risks, conflicts of interest. Hey investor, guess what? I'm getting a $100,000 acquisition fee at closing. Are you buying the property because you're getting a fee or because it's a good deal for you as the investor, right? That's a conflict of interest, right? All that's disclosed in the PPM. Sources and uses, fees. This is like a 50, 60 page document that we prepare, right? Very important. You give it to the investor doesn't sign it. They just have to have access to it, and you give it to them. I can probably do a some of this, but how does the sponsor make money? Right? Acquisition fees, asset management fees, refinance fee, disposition fee, and distribution of cash flow and profits. Also the tax, the tax write-offs as well. And what do you do? Right? You're ready to make an offering. What do? First thing you do is you're going to prepare your own offering memorandum to your investors, right? So your pitch deck that has the underwriting in it, it's got the property information, it's got the business plan, right? It has everything he needs to do to solicit an investment. I like to see, what's a hypothetical return structure for a $100,000 investment? Like if I give you, and I'll put that on a pitch deck. So hypothetical return structure, $100,000, right? What are the tax benefits? Once you get your business plan ready to go with your pro forma, we'll prepare the operating agreement for the investment entity and the subscription agreement and the PPM. How do you build up your investor database? How do you find these investors, right? Building that database now. Attend events like this. Join D's community. Get in investor meetups. Invest in other deals. I really like this idea, right? If you've got $25,000, $50,000, invest as an LP in someone else's deal in this community, right? That builds your track record. Even though it's as an LP, you're still building your track record as a multifamily investor, right? And then work on building your team, right? Underwriters, asset managers, investor relations, attorneys, brokers. All these need to be in your team. This is a deal we worked on a while ago. I have this slide here just to kind of show you this timeline. And this is probably the last thing we do. So we've got the PSA was executed in March. We've got due diligence was May 16th. May 27th, we issued the PPM, and we have an investor portal, right? And then we say, guys, you need to get your money in by June 15th because you signed the subscription agreement June 19th. Capital is funding June 26th. July 3rd is your closing deadline, right? So just to give you an idea, and then again, this was the acquisition summary. This was taken directly from a pitch deck. Just to give you an idea of what you need to be preparing. All right, that's all I got. I got a couple vignettes, but I think I'm out of time.
All right, real quick though, because you dropped a lot of jewels, so that told you a lot of information.
Yeah.
I'm gonna get a quick question. Anybody want to ask one question? Todd, man, this guy, that's an attorney, right? They charge a lot of money. How much cost to?
Well, yeah, good question. So we typically flat fee this work for like $12,500. And it's a flat fee for everything. That's your both operating agreements, your PPN, your subscription agreement, your investor questionnaire, all the SEC filings, everything.
Yeah, and that's a great price, right? That could be $18,000, $20,000, but guess what? It's $12,500 as part of the money that you bring to the table to do a big deal. That was good to have when you start with $3, $4, $5, $10 million, try to raise $2 million a first deal, $1 million a first deal.
Yeah.
Is that the same price for a fund? You do that?
Fund maybe a little bit more. Yeah, because the exemption is a little bit different. Yeah. Funds are usually 15 to 20 grand.
And you do that?
Yeah. We do fund work as well. Yeah, absolutely. Yes, sir.
Todd, you said how the sponsor makes money, there's acquisition fees and asset management fees, but then before that, you said that you have to have a certification to charge a fee?
A certain what? No. You can't charge capital raising fees, right? You can't, like, someone can't say, hey, I'll bring, 10 of my guys to come in to invest $1 million, but you gotta pay me $25,000. You can't, it's not a quid pro quo. Those acquisition fees are in the operating agreement, and the LPs are paying you as the GP manager for buying the property.
You know, you get you're like somebody bring up, say for instance, you're trying to raise $3 million, right? And Todd come in, he bring some investors in $1 million. I'm gonna give him $1 million worth of that 30% of the GP. That's how he comes on as a GP.
Right. That's right. Yeah. Yeah, that's the strategic partnership. That's how you that's your only real workaround from, because you can't pay them like a capital raising fee, right? You have to bring them in as part of the GP.
So you can actually have someone come in, like say I have a network of people that are high net worth people, and I say I can bring in each person a certain amount, and I get a GP percentage just based on that.
Correct.
Yeah, if the sponsor allowed, normally the sponsor say, hey, we raising $10 million, and you're gonna bring, we would say a minimum we want you to bring in $2 million of that. Something.
The fund to fund would be a solution for what you're talking about.
Yeah.
So,
Yeah.
yeah.
Yeah, fund and fire. We'll go over those types of structures too, talk different ways to raise capital and all that.
Yeah. But yeah, you get a GP spot for bringing in your investors, or like Vince is talking about, we create a separate fund for you, and then that fund, because it becomes an LP investor, and then you have some economics in the property level, and then also at the fund level.
Yeah, the problem normally, what's normally happens, no one can never raise money. They think it's so easy to raise, right? Then they never hit the amount of money that they said they can bring in. And that's the part that the sponsor is not being able to depend on, especially people that are new, just raising capital, because we got a closing date, and we got $300,000 to $500,000 of non-refundable money at the closing date that can go to the landlord. Right?
Yeah.
So, thank you. Todd.
Yeah.
Yep. All right, so I'm gonna bring up one of my man. There he go, Ken. All right, so check it out. This part right here, all right, is probably one of my favorite pieces, and I want you to listen. This is a game changer. All right, I've been teaching. We talking about, he said, what series? What since 7? Because I was gonna be a financial advisor. All right, because I used to teach people how to invest and all those things like that. Many years ago, something came across. It was, I shared this with Ken Weber, was that who was running for president? Who we talked about?
What was that?
Who was running for president? They had the all the money inside there.
Mitt Romney.
Mitt Romney, right? Mitt Romney up there, the guy, he had like $160-70 million in his IRA. I remember it was many years ago, and I started researching. I'm trying to be a financial advisor. I know that you only can have and put so much into a 401k, so much into an IRA. But then I realized he had a self-directed IRA. I'm like, oh, okay, what's this? Okay. I learned that many years ago. 12 years ago, I learned about that. And I would tell you, for 1 out of 100 persons, 1 out of 100 knew what it was. More people, more educated. Our capital stack or our deals, our partners, we have a lot of investors that uses their 401k, their TSP. We show them how to convert it over into a self-directed IRA so they don't have to invest in the rookie stuff no more. The stocks and mutual funds where you get no pay, we don't get no real loss, all those crazy things, right? So what we're doing is I'm bringing Ken, he's gonna be talking to you. He's a great partner. I've been working with this for them for many years. And Equity Trust, Ken Weber, come on up here. All right, cool. Yep.
How do I turn this on? Is it on?
Is this being recorded? There we go. All right, cool. Hey, I'm actually they said I got 30 minutes, so I'm gonna hold it to it. Is that cool, Dean?
Yeah.
All right, a little bit about me. I've been with the Equity Trust for 8 years. Helped out roughly around $25 billion move over to Equity Trust, 35,000 clients across all 50 states. And I was a licensed representative with